Hello and welcome to BQ Prime. I'm Hiral Dadia. One segment that is in focus is the oil and gas space. On the way crude oil has been panning out lately, what does this actually mean? Joining us on the show is Probal Sen to discuss more in terms of what is this and what are the moves that are expected going ahead. Probal, good afternoon and welcome to the show.
Thank you.
Prabal, an
Pleasure to
interesting
be here.
report that you've written with regards to the way crude prices and crude inventories that have a long lasting inverse correlation. Now, clearly, that the way the movement has been now, that has actually thrown up an anomaly in the trend of crude plus the product inventory and prices, which historically have shown an inverse correlation with each other. Firstly, if you could just help us understand how is this actually happening now?
Yeah, I think that's been what sort of has been interesting about the recent trends. It sort of follows common sense that when inventories across the developed countries actually fall, the natural action would be to rebuild those inventories, and therefore crude prices should see supply tightness, and therefore pricing should actually go up. And which is the thing that we found most surprising, that this anomaly that's open. If you look at the largest inventory that is maintained, which is the U.S. Strategic Petroleum Reserve. Their 5-year average is basically somewhere around 500 to 600 million barrels at this time of the year. And it is currently running at less than 250 million barrels. So obviously, there's a lot of, rebuilding that still needs to happen. In addition, if we look at the inventory situation of the normal gasoline and diesel inventories, which are held by refiners and other participants in the market, as well as the inventory levels across OECD countries, which essentially all maintain significant amount of inventories, keeping in mind their demand requirements. Even there, what we do see is that there's a significant build that should actually come. But what has driven the softness, however, is that there's this imminent, or rather, there's this impending threat that is continuing to be built up about recessionary trends in the US. The China demand reopening, post December, when the country was fully opened up, there was expected to be a much more material delta in terms of, the demand buildup that was expected to happen. Yeah, that hasn't really come about to that extent. So that has completely sort of obscured the kind of supply tightness that we continue to see in the markets, and that is what has caused this anomaly. So our sense very clearly is that the demand tightness, or rather the supply tightness, will start to make an impact. We are already seeing reports that US is finally looking to start to rebuild the SPR inventories, and that should sort of have a more bullish impact on crude prices going forward by the end of the year. At least that's the sense that we have.
Right. So, overall, if you could just help us understand, there have been sanctions. Russian crude has largely managed to still actually flow encumbered, which has boosted the bearish trend in crude as well as you've been mentioning. Now, what would a break in an anomaly like this actually mean from here on?
Well, I think very clearly, once the sort of inventories start to, again, in fact, what will also happen is that once the signals start coming through that inventory is starting to rebuild, you will start to see crude prices ramp back up, because one critical factor and one critical unknown here, as you rightly mentioned, is, are there any other disruptions of Russian crude that we could see in the markets? Frankly, we have no idea how or in what shape the conflict will be 6 months down the line, whether there could be even more of sanctions, there could be a more effective implementation of pricing sanctions, or physical sanctions on Russian crude. And secondly, whether OPEC plus, the body which has been pretty much becoming a much more influential force, let's say in the last 2 3 years, than they have been in the recent past, whether they hold on to these production cuts that they've put in place, or they sort of reverse it in some way. So these two factors, alongside the kind of demand recovery that we do expect, China has to come back to growth in some measure, even though currently their PMI data suggests that the demand recovery will probably be much slower than what initial estimates were, and that is what is causing the softness. But once that demand comes back, US starts to rebuild its inventory. What you would probably see is once again inventory levels rising up, but then pricing also rising up alongside in the next 6 to 9 months.
Right. So overall, now it's absolutely clear that there is a disconnect between inventories and pricing, right? As a next step, from the macro indicators, what are the signals that we are picking up in terms of by when we expect normalcy to return? And what I mean by that is, once normalcy returns as well, what should that logical standpoint be in terms of the demand? How much demand do you think will be needed so that there could be some amount of supply deficit that will start coming in?
uh, I think that's putting me on a spot really for asking me to put an exact number. But just to give you a perspective, most industry estimates, including
Hmm.
the IEA or the OPEC, which are the two big bodies that track global oil demand, they point to somewhere around 1.5 to 2 million barrels of demand growth for CY 23 versus CY 22 levels. Now, assuming that there is some sort of economic slowdown that comes through and
Hmm.
the demand momentum is lower, even if there is a nominal 500,000 to 0.8 million barrels a day of demand growth, that itself is not something that current supply can cover. So straight away, that incremental demand creates a supply deficit to the same extent by the end of the year. So
Right.
that's the only perspective I can give you.
Right. So, what would this actually mean from a pricing trend point? Because $70 to $75 per barrel is what we're tracking currently, right? From here on, what are those next levels we should be looking at in terms of an immediate up move and run up to 24? What is that number looking like?
See, I would think that earlier also the OPEC countries have indicated that somewhere between 80 to 85 is a level that they would aspire to keep crude at. I think they have repeatedly also stated that they do not support runaway prices because that tends to have a demand destructive effect down the line, which is not something that's conducive to their interests. So
Mm.
the effective range, therefore, my sense is that given the kind of deficit that exists, I wouldn't be surprised if crude does touches $85 by the end of the year. I think that is a level that one would probably look at. Obviously, it's very difficult to sort of put an exact range on it because of the kind of financial speculation that happens, the geopolitical events that can influence it. But based on physical market signals and what is going on in terms of demand, I would say that $85 is a reasonable level to expect by the end of the year.
Right. And from a demand perspective as well, clearly you have the IEA as well as the OPEC, which are indicating a 1.5 to 2 million barrel per day kind of a demand growth for crude. And this is over calendar year 23. Now, with this, we are talking of the demand concerns, recession worries as well. Do you think there is a real possibility of a deficit of little over 1.5 million barrels per day?
No, that's what I said. That reasonably speaking, these demand estimates tend to be fairly dynamic, and I think will be revised every month as we go
Hmm.
along, depending on how Chinese data pans out and how the U.S. inventory build happens, and what happens to the U.S. economy. But that's what I said. That if you notice the kind of CY 22 demand data of, I think it was
Yes.
we ended the year at 99.9 million barrels a day of consumption, and global supply today is at somewhere around 100.2 or thereabouts. So even if you build in a nominal growth of 500,000 barrels or zero point 0.7, zero point 0.8 million barrels, then we start to basically become extremely tight from a
Hmm.
demand supply perspective, which is the point that I was making. And this obviously does not sort of include, any incremental demand coming through because of, a larger inventory build than what is sort of factored into industry estimates currently.
Right.
So both of those can still create a deficit. It may not be as big as 1.5 million barrels.
Right. So clearly, this will then lead to an increase in pricing, is what we are indicating, right? Now, what would this actually mean from a spreads perspective from here on?
Well, given that what we are estimating is that the pricing boost this time around will be led by demand and not just supply tightness, one
Hmm.
would expect a proportional increase or improvement in refining product spreads as well. As you would have seen, refining margins have actually been very, very low in the last couple of weeks. They have fallen, I think, to an all-time low. I think in some week it fell to less than $1 if I look at the Singapore benchmark. So we think that normalized spreads or normalized GRMs of $5 to $6 is something that we would still continue to build in. And given that this time around in the last year or two, what's been interesting is that the Singapore GRM strength or weakness has been primarily led by petrol, diesel, and ATF product spreads, which have a much higher weightage in Indian refiner slates than they have in the Singapore benchmarks. Singapore benchmark is essentially a theoretical product slate, which sort of
Hmm.
has a higher weightage of LPG, naphtha, and a couple of other products, which Indian refiners don't produce as much of. So that has been the reason why if Singapore actually improves to $3 or $4, it implies that OMC margins will probably be closer to 7 or 8, and Reliance would probably be closer to 9, 9.5. Because, as I said, the weightage of those products which are driving this trend is much higher for Indian refiners. So
Right.
that is what we think should
Hmm.
happen in the second half of the year.
Right. So does this mean then it becomes a positive with regards to where upstream companies go, but a squeeze coming in terms of OMC's marketing margins?
Well, for OMCs, it's a bit of a balancing act right now in terms of how much do they gain in terms of better refining margins versus how
Hmm.
much do they lose in terms of marketing margins. My sense has been that as long as they can make somewhere around $7 to $8 margins, and if that is what product spreads sort of settle down at, they can still hope to make normalized marketing margins of somewhere around 2 to 3 rupees a liter. So it may not be anywhere near the record levels that they are estimated to be making right now, where as per our estimates they're probably making as much as 6 rupees on a blended basis from petrol and diesel, but it will still be healthy enough for them to report reasonable earnings growth after what is slated, what is obviously going to be a very, very weak FY23 by all accounts.
Right. And Prabal, with everything said and done, India, a lot of dependence that happens with regards to Russia, right? Though now things are changing. The bargaining power that India has with Russia as well is decreasing, and that's what everyone is pointing towards, taking the way China demand probably is slightly on the upward trend. Taking that price point into consideration, how do you see the import of crude oil into India from a pricing perspective?
Well, I think what has been interesting is that even with the kind of increase in Russian crude as a percentage of Indian crude,
Hmm.
India's crude import bill actually did not really see any significant savings. Some data that we got or that we read suggested that there was probably a 3 to 4% saving that happened in India's overall crude import bill. So while the import of higher Russian crude has created a different supply source and probably has given us some better negotiation power for a while with our Middle East suppliers, the fact of the matter is that at least the data doesn't suggest that anybody got those $10 to $15 discounts that were being speculated on Ural's basis and what the price caps would suggest. I don't know what additional costs are being incurred by Indian importers in the form of freight or having to arrange insurance or having to arrange for vessels, because all of those have been constrained in view of the sanctions that have been in place for Russian crude. But if the sort of there is no incremental Russian crude actually coming through, I don't think that there is a huge or a material impact in actual crude costs that Indian refiners are paying, particularly in view of the fact that the benchmark crude itself has actually been coming down. So
Hmm.
to that extent, I think from a refining perspective, you're still going to be okay. Yes, I mean there could be some impact of 5 to 7% here and there, but it's not going to be material to change your estimates too much.
Right. So, Prabal, overall, if you see in terms of a stock specific perspective, how would you advise someone to play the oil and gas space currently, dividing it between upstream, downstream marketing companies, and someone who's invested or someone who's looking to invest?
See, we have been pretty bullish on the upstream companies. If in terms of pecking order, I would still say that upstream companies are something that should benefit. With or without windfall taxes, their net realizations are likely to remain at somewhere around $75 per barrel of crude, and gas realizations, even with the new ceiling put in at $6.50, are still well above their last 7, 8 year averages. When you add to that fact that their production should also start to grow, specifically for ONGC, there should be some growth from the KG Basin asset production, and for Oil India, the additional infrastructure that is being created in the northeast should provide more avenues for their gas production to improve. So to that extent, I think upstream I would remain fairly positive on, particularly given that even with the recent run up, their valuations remain dirt poor. The ONGC still tracks at somewhere around 3.5 times 1 year forward multiple. Oil India is slightly more at somewhere around 5 times. So from whichever way you look at it, those companies stand out. For OMCs, I think it's a bit of a tactical play versus a structural play. I think in the near term, till marketing margins are strong, um, I would say that HPCL probably benefits the most, but in the longer run, structurally, I think BPCL should stand out because of its more balanced refining to marketing ratio and the fact that Mozambique could actually start to come back into its portfolio now that Total is talking about restarting work on the project.
Abs- Yeah. And in fact, if you see even in terms of the stock price, BPCL, Indian Oil, ONGC, all of these counters have actually hit a 52-week high recently. So there is a good up move. But as you're mentioning from a valuation perspective as well, there is still value in looking at these counters from an investment perspective. Thank you, Probal, so much for joining us on the show. It's a pleasure to
My
speak to
pleasure.
you and great insights that we've picked up. And this is something we will be watching out for as well. Thank you. Stay safe and speak to you soon again.